This is Robert Kraft, and I'm your host on the Planet MicroCap podcast. And with me today is a very special guest, Mr. Peter Rabover. He is the general partner at Artko Capital. Peter, welcome to the Planet MicroCap podcast. How you doing?
Thank you. I don't know if I'm very special, but I appreciate the introduction. So that's here we are.
Hey, anybody who's willing to actually take the time and talk to me, there must be something special about them. So I do appreciate it.
Well, as I said previously, it's Wednesday afternoon. Markets are closed. It's Christmas, so a glass of bourbon and a good conversation, and I'm ready for it. So.
Hey, brother, l'chaim. So with that said, let's get started with your background. What would you say has led to where you are at today? Starting of Arco Capital and the whole deal.
Yeah, so I thank you for the question. I get that asked a lot, and I guess I don't really get tired of talking about it because it's certainly been a journey. But when I was 19, an undergrad at Duquesne University, and I was just kind of trying to figure out what to do. I had asked one of my professors during, and I want to say it was the summer of 99 or 2000, to for some finance books, and I have never spoken to this guy, and so he handed me a giant theory of finance textbook, and I kind of finished it over about 2 weeks. I had a stupid computer lab job on campus, and that's all I did. I was just reading it, and so I devoured it. I read it, and I think this was like a good time in my brain development of figuring out, hey, this makes sense. This is different from what I thought the stock market stuff is, except that the whole like theory of efficient markets and all that stuff, that didn't really make sense. It didn't jive that there's like this whole active management industry, but there's efficient market theories, and that was still relatively new in the late 90s. And so it didn't make sense to me. So he said, okay. So he handed me the Warren Buffett letters, basically, this book. And he's like, read that. And I read that also like in a week, devoured it. And I was like, yes, this makes perfect sense. Like buying cheap assets and hopefully, with the low margin of safety, you're not going to like low risk or whatever your tolerance for risk is and higher upside. And so that made much more perfect sense to me, very intuitively, like clicked right away. And that's when I got hooked. I said, like, this is what I want to do. And I joined our investment club right away. And then the following year, I ended up, it was like $100,000 undergrad portfolio. Unfortunately, or fortunately in some ways, it happened to be like right during the dot-com bubble burst. And so very valuable experience in that. I was like, seeing things go down 80%. And then the following year, you had the WorldCom, you had Enrons, you had all those things. And so I kind of brag about this kind of in a funny way, but I was born into the investment world during like almost the worst possible time, but also the best possible time, which made me a much more risk averse investor. And seeing things go down to zero, seeing things go down like 80% off of a hype mania. And that's kind of how I was shaped. And I think that's a little different from what the people who are been born into the investment markets the last 10 years, this continuous bull market and things seem pretty easy. And so I like to draw that distinction pretty well. And, also having sat through the 2008, bubble pretty at a seat where I was responsible for 1/3 of our portfolio. So that's kind of the background, right, of what shaped my value investing philosophy. And I think you wanted to ask a question.
Yeah, I was gonna say like, so you're in college, you get these books, you're digging through them. At 99, you're like, this is it. I know what I want to do. So from there, you graduate. I mean, then what? I mean, what
Yeah,
then?
it was interesting. So this is what I wanted to do, right? And
Yeah. But like, what is this? You don't even know yet. You're just like,
yeah,
I
well,
guess
yeah. Well, no, it's interesting.
invest
There was
stock.
all these websites back then, like Wet Feet and Monster and all.
Yeah.
It's like I didn't. Duquesne was a good school, but it wasn't like the top market school, and nobody certainly came to recruit from Wall Street at Duquesne. And so I didn't really know how to get into this world. And I had a corporate finance internship at a Fortune 500 company treasury department, and the writing was kind of on the wall that there was a recession coming, and they offered me a job, and I said, okay, I'll do this for a few years, except that like literally on the eve of my graduation, which was December 2001, they pulled the offer. They kind of laid off half of the corporate staff to begin with. So yes, I was slightly unemployed in December 2001, and I had a couple of choices. One was I've always wanted to do the Peace Corps, I did end up doing it. And then the other one was the U.S. Steel, which is a large corporate manufacturing company,
Sure.
in their kind of audit department, which they assured me was more finance focused than accounting focused because I didn't really have that much of an accounting background. So I ended up taking the U.S. Steel thing, and I was there for about a year and a half. I got to, luckily, I got to work on some pretty good deals over there. They even sent me to Serbia for 6 months, whole other different conversation, and working a bunch of deals there.
Wait, is that where the Russian Bear nickname came from? I'm not.
No, I wrestled in high school and in college.
Okay.
And I'm Russian, and so I think my friends sort of stuck with Russian Bear. And since then, I've both like the Twitter handle, and I don't know. It's one of those things that I certainly didn't push for, but I'm not gonna fight it, and it's kind of a fun name, right?
Nice.
And so anyway, so I ended up taking U.S. Steel, and I said I'm going to study for the CFA tests, exams, and try to get into the investment management world. Once I get the CFAs, I'll get my requisite finance experience, but I think CFA is a little bit more must-have now rather than back then. It was a head above above ground, and so. And so I didn't really enjoy U.S. Steel. It was very like middle management path, career oriented thing, and I'm more of a bull in a china shop kind of guy. And so I ended up going into the Peace Corps, and I was in Kazakhstan for 2 years, and
Wow.
That was kind of interesting. I taught business at a university. I did small business consulting, and we started a micro lending fund out over there as well, the first one in Kazakhstan.
Hold on. Time out. Well, yes, high five on joining the Peace Corps. I didn't realize that you could even do that in the Peace Corps. I thought when you do the Peace Corps, you're building homes and all that kind of stuff. I didn't realize there was even a business route you could go down. That's pretty cool.
Yeah, no. It was an interesting experience. Keeping in mind I was like 23, 24, and wasn't. And my whole goal was to get back into investment management as well. So I was studying for the CFA while I was there. I ended up taking level 3 in Kazakhstan. I had to take like the 42-hour train ride to take it in Almaty, and there was 2 other people in the room. It was pretty funny actually. So it's but my point is, all of a sudden, I was done. I was this 24-year-old with a CFA charter back in the United States in San Francisco, where my parents had moved, and I had full intentions of going to New York, joining Wall Street, etc. And I had just, I figured while I'm hanging out on my parents' couch, I had applied for some jobs in the Bay Area just to practice some interviews, and I think people were like, "Huh, who is this 24-year-old with a CFA charter?" So I got a bunch of interviews. And one was actually with a MicroCap activist guy. His name is Andrew Shapiro, and that was a pretty interesting interview that I've had with him, and I've kept in touch with him over the years. But in the end, I got a job offer from a company called Han Capital Management, and they were a mid-cap value shop. And I would say, I count my career in lucky, like I guess in some luck, you need some luck. And I just ended up having a really great boss, John Schaefer, who was really committed to my growth as an analyst and but at the same time, let me run with my ideas and my book. And by year 3, he let me become a senior analyst, and I ran 1/3 of the book over there. And I thought that experience was both invaluable, both from like the mid 2000s to the 2008-2009 crash, having ownership of the portfolio. I certainly made some mistakes on there. I've certainly had things go down significantly, but I've also made some very good picks in the portfolio, including, it's kind of funny I tell this story, but the last thing I did is I put in Valiant Pharmaceuticals at $5 per share into the portfolio in early 2009, late 2008, and before I left for business school, and that clearly worked out really well for them. And so I've always kind of joked with my boss that you're welcome. So. And I had gone on to business school, and I consulted for them for a little bit. But so that was kind of, I would say this was a more defining experience that I had in the industry. And I would say, if I had to give a recommendation, if you're choosing between money and experience early on in your career, I would say pick more experience rather. But so I ended up going to University of Virginia, Darden graduate business school in 2009 to 2011. I had a very interesting private equity internship with a Goldman shell firm consolidating the prison telecom industry. And that was just a very interesting summer, like really hands-on. And this was certainly microcaps. The deals were like 30 to 100 million. They were private, not public. But, this is certainly the field that I play in now. And being hands-on and visiting all these targets, I actually helped save a $30 million deal that we had. That was really good experience, I think, for what I'm doing now. Mm-hmm. And after Dearth, I ended up getting a large cap value shop job at a company called Scharf Investments, another pretty reputable shop but it was 25 large cap stocks with a 6-person team that turned over 3 or 4 stocks a year. And you didn't really there wasn't a whole lot to do. And I think pretty boring in some ways. Large caps are pretty boring. And so it just wasn't a good cultural fit. I think it was by early 30s, you sort of figure out that you might not fit into certain cultures. And I'm always, as you can see by my Twitter, I'm always the bull in a china shop kind of person. I'm not shy about it, and I'm pretty comfortable with it, actually, to be honest. But it certainly wasn't one where after interviewing in my mid 30s after Scharf, I said, hey, I can't really keep doing this because this is I can't keep working for somebody in this industry who and kissing ass and being politically correct. And that's just not me. That's not, if somebody says something stupid, I will tell them you said something stupid. So, which is all to the impetus of starting Arco Capital 4.5 years ago. And so the focus here is, I worked for a mid-cap value shop. I worked for a large cap value shop. And we did really well over those years. I certainly had some successful picks, and I could convince myself that, hey, I'm a really good value investor, and I can launch $1 billion shop and collect large fees. But realistically, that whole theory of finance textbook and all the studies since then been always in the back of my mind. And I think with the rise of index funds, I felt it would be somewhat unethical for me to try to charge the fees that I would like to charge for my skills, versus to the people whose alternative realistically much better in index funds, until we hit some sort of point, separate discussion. I think we're going to be close to that point where active will start to be popular again. To me, it's a cyclical, not a secular issue. But having said that, I wanted to see where could I create value and charge, performance fees and management fees, and still create value over that. And I've just discovered small caps and micro caps were still a space where you could make significant returns that are off the run. And I'm sure we'll discuss this in a second. But the concept there is you just have to stay small, right? And over the years, I figured out that I thought my ideal size was $50 million. I actually think it's 35, right? And so
that's still hard. That's still hard to deploy in microcaps.
Yeah, well, in the strategy that I would be doing, it wouldn't be easy, but I have certainly put in some protections, and we can talk about that. But again, the concept here was to create a value-added, unindexable product for my investors, right? Gotcha. Where for the most part, I'll be honest. This past quarter, we added Philip Morris. It was just too stupid not to add it, right? It's a mega cap, but for the most part, it's been off the run micro caps that are $50 to $200 million in size. And I think we've done pretty well in terms of staying by our original intent of providing a alternative product that's a little bit probably closer to private equity in liquidity aspects of it versus public equities. And that's where it ends up. The real alpha in this business is time. There's time arbitrage that, you have to be patient. And so I've created a lockup structure in our fund that's about 3 to 5 years. And there's a sliding scale for management fees on that. And so my goals are aligned with my investors' goals. And there's certainly a liquidity aspect, which also aligns with a lockup, right? So those are the two sources of alpha: time arbitrage and liquidity. And I wish there was more magic sauce to it, but I think it's the ability to stay patient and having an investor base that's aligned with your goals are probably the two secrets to the success in this particular space. So that's that's the spot. So
100% interview over. No, I'm just kidding.
actually, while I'm talking, ironically, I just got a message that says WorldCom CEO Ernie Ebers granted early release. So how timely on this whole situation, right? So but let's keep going. So
Yeah. So I want to dive in here. And by the way, before I dive in on your investment strategy, I got to say, you mentioned Andrew Shapiro, friend of the podcast. We love Andrew. And so that's a small world.
yeah. Well, it kind of is like, right.
Yeah.
MicroCaps it's a small world, right?
It's a small world. But so let's dive in. Your investing strategy. What would you say it is, and how would you say it's different? How would you say your microcap investing strategy is different than maybe some of the other fund managers out there? And you mentioned it a little bit already, but there's a lot more.
It's really interesting. So I had started 4.5 years ago, and for all intents and purposes, I think one of the key pieces that's sort of missing in our industry, which I think there should be some sort of school for it, I don't know, is the transition for analysts from being an analyst to a portfolio manager. And I don't think we do, as an industry, a well enough job, both from the top business schools perspective to mentorship of providing those sort of skills. So I think that's sort of been one of the bigger things, and I would like to discuss it. And so I think when you are an investor, so what's been the biggest difference, I want to say, evolution of the last 4.5 years, I've sort of stopped seeing stocks as individual securities, which is what they are, like, right? But when you're an analyst, that's what you're wedded to. You're pounding the table on this, et cetera. And I've started to see things much more in a portfolio context. So I think, to go back to your original question, part one would be part of my secret sauce is maybe stop seeing things as a black and white. This is the situation that I am pounding the table on, and rather seeing it as a probabilistic portion of your portfolio, like, right? And so instead of saying, hey, I think this thing is worth 100, it's 20 today, and I think it's worth 100, what I've started to kind of think about is, I think there's a 70% chance that this thing could be 100, and I think there's like a 20% chance that this thing is maybe 15, like, right? So and so I've started to think about things in a much more nebulous way rather than some price targets or things. And one of the things that going back to my thing, we don't do enough training for people. I've actually become a much better poker player, and I've and this year I got to play professionally a little bit, and I'm pretty excited about it. I've done pretty well, and I think playing poker has made me a much better investor, and being a portfolio manager, and I think being an investor made me become a much better poker player. So it's kind of a feeding thing. But when you are playing in tournaments, you are certainly stop viewing each individual hand, and you're viewing it in terms of probabilities, the size of your stack, and really kind of the people around the table. And I draw the distinction to microcap. A lot of times you are around the table with only, like, in the poker it's 9 people, but in microcaps maybe it's like 30 or 40 who are only doing
or 4
or 4, right? Or 4. I don't know. And so I think, to answer your question, I think that's been the transition that's made me slightly more successful, I think, in that sense. And I, both from taking losses and adding to certain positions, doubling down on certain positions, and cutting some losses, I think that's made me much better, because all of a sudden, you stop thinking about it in terms of like, oh, I invested in this and I told everybody about it, and now I have to stick to it, versus, hey, I think my loss aversion has sort of changed on this, and I'm not comfortable with it, and so I'm going to sell it even though there's still upside. So those are kind of things.
So would you say that ties in with, because you mentioned this in your investor packet, would you say that ties in with this idea of enhanced portfolio construction? This idea of it's not just black and white. You're really, I don't know. Do you have a formula that you look at when you say, okay?
Yeah, it's a little bit. I mean, I would say so. The strategy is kind of twofold, and one is the old school value strategy, and that's about core value. It's about 80% of the portfolio, fluctuates between 70 and 90%, where we like to have, 8 to 12 positions in that bucket at significant sizes of 8 to 12%. And the focus in that in those situations is on the downside, right? Because everybody's been wrong in this business. Everybody's lost money. I think it's a thing that you have to admit, right? And so the focus here is, if you're wrong, manage your wrongness, I guess, so to say, in the sense of if you're wrong, make sure it doesn't cost you, right? And so that's the focus, right? And in that sense, it's still the old school Warren Buffett. Sometimes there's occasional net. I think there's an art to it that you have to use your experience to evaluate. Sometimes it's not just a balance sheet that's a downside protection. Sometimes there's a hidden asset like a brand name or a customer base that it's really hard to value, but your experience tells you that is worth something in the worst case scenario. Right, this company's worth, and it's actually you actually see that much more in microcaps, where things aren't working and the management decides to sell, or there's more activists and stuff like that. And so that's I've actually become much more comfortable with that. And so that's the 80% of the portfolio. You're taking big bets. You're taking 10% bets on these things, and you're hoping for longer term. I would say our lockups are average is 4 years, and so you're looking at 15% IRR on that. That's kind of my goal. It's worked out pretty well in that our portfolio is about 21% gross IRR. So, but I still think it's somewhere in that space, in the high teens space is what we're looking for. And so that usually ends up, you're looking for 100% upside in 3 to 5 years, and sometimes. And I can certainly point to our successes that we've had a number of positions that have gone up 100, 200, 300%, and based on how it's played out. And some losses that we've had have been in that 20, 25% range. So,
well, let's go down that road, because one thing I wanted to ask you is, and you mentioned this more or less already, when it comes to microcaps, there's always hair. Hair on every deal.
They're never going to be high. They're never going to be Danaher's. They're never going to be, Johnson & Johnson's. It's always going to be something hairy.
Yeah.
And you just have to be comfortable with that. You just have to.
Well, I was going to say, I mean, you mentioned you've had some 100, 200% successes. Can you name any one of those successes that you say at first glance you're like, ooh, that had some hair on it, and then ultimately there's something about it that you're like, all right, well, this is still something that fits most of my criteria, but then you ended up doing great. I mean, do you have some
for example, so one that's worked out really well this year, and I think it's still a good one, is a company called Pharma. And I don't like Pharma. I think Valiant was one of my last ones that although I did used to cover Johnson & Johnson and Abbott for our large cap fund. So, but I certainly never felt like I had competence in the drug business or anything like that. And so, and even Valiant original investment was more based on an asset play rather than any continued growth that Michael Pearson brought in. And so, I would say Repro was a good example of that, where it hit a lot of check marks, but it had some hair on it, including it had the real value of it is this contract manufacturing business that's like 50% EBITDA margins, double-digit growth, incentivized management that has kind of indicated that the company is for sale, but it was trading. The problem was they've plowed a ton of money into this drug, like hundreds of millions of dollars into this drug, and that's not a place that I wanted to be in at all. Right? No, it's a very binomial structure where I know Harvard MDs that are hedge fund managers that are much better at these sort of things than I am. So that's not I don't want to swim with those guys, because they're much better informed than I am on these things. And so I wanted nothing to do with that drug. I wanted the CDMO business. And so management said, hey, we're done with this drug. We spent money on it. The FDA rejected it twice. We're going to do legal stuff, but we're not going to do more R&D stuff. So we're done plowing money into it. And then all of a sudden at that point, this company had become just a contract manufacturing thing with a free optionality on that drug if that happened to hit. And since then, the company has announced a spinoff of the drug, which it's even much cleaner. It's outperformed market's expectations, right in line with mine on the CDMO business. But that one was one where there was hair on it that I wasn't thrilled with, but it was so cheap. I think it was like the CDMO business was like 4 times EBITDA when the comps were like 16, and it was a significantly much better asset that it was. Yeah, you put your money in the market, and it was trading like a failed drug company, not a CDMO. Like it went from like 13 to 5 or 6, so we added between 6 and 8. It was great. I guess relatively speaking, with the spinoff, it's like 19 today, so that's worked out really well. Where we put on, I think it's worth 30, like right. And so I think there's still significant upside there, but was one where there was certainly hair on it that I felt comfortable with that in that risk reward spectrum. So.
Gotcha. Yeah, I mean, it's so funny that you mentioned the first one being a healthcare company, because I feel like most microcap investors that probably both of us know, that's like that and mining and junior mining are the two that were just like, oh, like even if the cycle's at a good timing, you're still just like, oh, it's just so far outside my core competency. Like, how do I wrap my head around this?
Right, and like I said, it wasn't like all of a sudden it stopped being a drug company, and it was like more of an high-end industrial company that just happened to serve the pharmaceutical industry. Right. And that was, a slightly different way of thinking about it. And it took a while for the market to recognize that, and, hence the time arbitrage thing that we were talking about. Right. So, yeah. So that's
well, here, real quick, just have to follow up. Are you a shareholder still in either Philip Morris, Repro, or Valiant?
Definitely not Valiant. I've never been in it, but like Repro and Philip Morris, yes. And so I guess that's legal disclosures.
Yeah. I just got it. So speaking.
Probably, yeah. I will just anything I say, I will let you know whether we're a shareholder or not, or we've sold out of it.
Perfect. So this leads me to my next question, and it comes to generating new ideas for the portfolio. As I said, healthcare is outside of my competency. I'd say it's, even though you're not a Harvard MD, it sounds like it's within your competency enough. but
it's within my competency to be able to see the value in the human psychological aspect of an incentivized shareholder base and board, and I think that's what I really like to focus on. And it had a stream of cash flows that could easily be modeled, and you could probably do DCF on it. We didn't, but that's and so. Like I said, it went from outside my circle of competence to inside my circle of competence. So that's one of those things. But I want to say there's a lot of people that I think what a way I differ from most people. Like somebody was tweeting the other day that's like, I have to know the most about this company than anybody else. And I'm sorry, I do not agree with that. I have to know the due diligence aspect of it, but I just have to be comfortable with that the right pieces are in place for value creation, and any focus on outside of that, I think, is almost noise rather than signal. Well, that's why I differ from other people.
I mean, it seems like that, like when you hear that, and I agree with you when I see that, I'm like, okay, like one, that's impossible, and two, really, to me, it just sounds more like hyperbole, where you're just like, when you're training for a big game or you're training for something a big event, you're like, I'm going to just be the best at it, better than everybody else. And it's more or less just to get to a point where either you can finish it or just, do the best you can.
So I have a story. I have a story for you that's kind of like along the lines on that. Like, right. So I've been vocal about it. Like, it's oddly, for a really terrible company, we've made a lot of money on it. USA Technologies, like, right? And so it's everybody's favorite, least favorite stock. And, for a long time, I was kind of a big bull on it. And it so happened that the CEO's the CEO's incentives were just definitely not aligned with the shareholders and with what the company should have been. And he clearly wasn't competent based on everything. But it all started with him chasing me down the hallway of a conference and screaming at me sort of when I had asked them a question why they raised money. And it wasn't like some short seller. I was like, he knew me. I've spoken to him like 3 times. I've met him in person. That he just refused to answer my emails why they did a secondary offering, like dilutive secondary offering. When a few weeks before he was telling me they were still on track for a potential sale somewhere down the line, And so clearly something had changed, and I wanted the answers, and he didn't answer them to me. So I went to the conference and I raised my hand and I asked him that question, and he, after the presentation was over, he screamed at me, chased me down the hallway, screamed at me for embarrassing him, etc. So clearly this was not a good stock. It was a good asset, but not in the hands of this particular man. And this played out clearly in the last year. If you've seen that full accounting restatement, etc., he finally got fired, thank God, last month. But I sold it, and I was sad about it, and it ran up to 17 from 550 where I sold it, but clearly crashed back down to 3. But after that, I had a bunch of hedge fund managers call me and just wanted to discuss it. And they were like, "Don't you understand their contracts? How lucrative they are, what position they play." I was like, "Oh, I understand all of it." They were telling me these, I don't want to say secretive things, but they're knowledge base that they've developed. Sure. And I think they missed the forest through the trees. I was like, great asset, true, but it's just in the hands of a terrible, terrible person who is going to run it into the ground. And they didn't want to listen to me. But to me, I think that's my sort of, level of competence, is not getting bogged down in those lucrative signals or noise things, but focusing on the bigger picture where, this guy was clearly not right for this firm. So that's and I'm sure you'll ask me about the management question later, but that's an example. And so for legal purposes, yes, I'm out of USA Technologies and we no longer own it or anything like that. So
I was going to segue right into that because in going through your deck and looking at your process when you find a potential new idea or an investment that you want to look at, noticeably that was out of it was speaking with management. So as you know, some microcap investors, that's so core to their criteria, talking to management. They need to talk to management. They have to get a good idea who they are, whatever, but yours, interestingly enough, look, it's not saying that you probably don't, but it just wasn't a core part of what that process was. So what is your take, on that?
Yeah, and I don't think it is. I would say, so my first firm that I worked for, Han Capital Management, that was part of their core process. They would refuse to invest in anything until they spoke to management. So in a way, this was actually a really good experience of, meeting with 300 management teams and, having these conversations, et cetera. And whereas with the large cap value fund, Sharf, we literally owned $500 million stake positions in some companies that we've never spoken to management with. My boss just didn't believe it. He thinks they were all crooks. And it was more of a qualitative kind of mean reversion strategy. And that was pretty, and so those were two extremes in this industry that I sort of experienced. And I had found there's value to speaking to management, but sometimes there's not. Sometimes they'll feed into your biases. They'll say the things that you'll inadvertently, lead those questions with that. And so I think there's a risk in speaking with management to creating biases for yourself. And so I try not to do it unless there is certain pieces of information that I need to confirm. But sometimes I don't need that. There are companies whose managements I speak with once a month or, and I go down, visit them. And then there are companies whose managements I've never spoken to, And so I think it's a case by case basis, and especially if the thesis changes, you kind of want to have more conversation. I think speaking with management is an art, not a science, but I think some people really get bogged down in the art. I saw some 26-year-old on Twitter claim that he's really good at, reading management body language. He's a CIA analyst or something like that. And sorry, I'm going to go with one of these on this particular one. No 26-year-old in the bull cycle can have enough experience to read management body language. And I think maybe there's some sort of art to that, but it's not for me. Like, right, I don't think that's it. But as far as like getting some valuable information, especially in small caps, and even at my small size, I end up owning 1 or 2% of the companies. I would say the art here is just proving to them that you are a long-term shareholder and you are aligned with their interest. And so, for example, there's a company of ours that we own. I'm not going to mention it. It's slightly controversial, but I had convinced the CEO of this company to go out, who was pretty wealthy, to go out and to silence critics, buy $1 million worth of stock on the market, like, right? And he did that. And I taught him that you put notes, you could put notes in the Form 4s, and he started doing that. And the CFO did as well. And I think that's pretty funny, like, right? And so they've listened to me, and they trusted me, and that sort of worked out pretty well. It certainly created a little bit more of a margin of safety for the stock. And then the board started buying it as well. And so I convinced them that this was a value creative action that they should have been doing for a long time, right, to silence their critics, like, right? And that's sort of, I would say that's an example, but I've never spoken to the Philip Morris management. I don't really need to, so it's fine. I think there's there is no direct way to do it. So right. I think the process really focuses on the margin of safety and on the upside, and making sure the ingredients are in place for the upside to happen. So,
right. So then going back to a question that I had originally, when it comes to generating new ideas for the portfolio, it sounds like you kind of do all the normal stuff, going to conferences and do you screen? Do you still screen?
Yeah, I've gotten. I would say the one thing I'm slightly proud of is that all of the ideas in the portfolio have come. There hasn't been one magic source that has made my ideas like really, really great. So I would say there's been conferences. You reached out to me on Twitter through my Artco Capital account. Twitter has been this unbelievable source, and I get like 20 ideas a week from people just wanting to discuss it. I'm overwhelmed with it. And so I think the key is, so I've built up a really, really good network of people that I trust. And so Repro came from somebody that I really trust, who called me and pounded the table on and said, like, Peter, this is it. Like, you have to take a look at it. Like, right. And so this was a person I trusted, and I certainly was convinced enough that, and I already had like kind of a built-in analyst who would help me answer questions, who's been doing this for on this particular stock for a while. And so I would say a secret competitive advantage for me is having a really good network that brings ideas to the table for me. And some of our successes in the past have been from that. There's also, Value Investors Club. It's sort of been iffy on its value, but it's certainly been. I've found an idea or two off there. Screening, talking to people. Look, one of the more successful ones, Joint Chiropractic, that we're out of. I had a bad back issue a couple of years ago, and I was just looking for back solutions, and I kind of stumbled on that, like, right. And so that was certainly one that came from personal experience.
Yeah, so, that one ran up in the last year.
Yeah, no, look, that was an example of one that we bought it at 550 and sold it at 18, and that's can't go wrong with that. Right? So I certainly think it's a valuable idea, but I think there's more risk on the horizon, and the valuation's pretty high. And so I think the one thing where I sort of differ with the Buffetts of the world is, especially today, where there's so much money floating around and technology has been much more creative, or has been much more a creative destruction force in a lot of business models. I just don't think you can have stocks that you can put into your portfolio for like 20 years and just close your eyes. Like, right. I think having a 3 to 5 year horizon and having those things work out at 100 to 200% certainly has been okay. Now, it's a situational thing. Like, one of my bigger positions that I am still in, Research Solutions, it's up 230%. I'm not selling it, like, right. And so we're going to own this thing till it hits 20. I think that's the things, So that's kind of one of the case by case basis. But as far as source of ideas goes, it's pretty diverse, and I highly recommend to people just to develop networks. I certainly read some shareholder letters of people that I trust, and I think I may have gotten an idea. I can't think of one, but I'm confident that I got one from a shareholder letter of somebody that I liked, and that's kind of it. So.
Well, let me ask you this, and what would you say as a microcap focused investor, fund manager, what would you say is your biggest challenge in this space and operating in this space? Let's see if we can get you a solution. Come on.
No, I mean, I think there's two different things. I think there's the portfolio management perspective of it, which is there are certain challenges associated with it. And I think probably the bigger challenge here is the like you said, hair. A lot of them have hair on them that you just have to be comfortable with, right? And I think that is a challenge that just works through experience, right? As is avoiding things where you can lose money, and that takes experience to know the 1,000 different ways you can lose money. And that's, interestingly enough, I think that's a good poker analogy, because what makes you a better poker player is just losing money in the most creative, losing your hands in the most creative way possible, right? And sometimes, and just recognizing that stuff happens in the world, and you do that. And I think that's the real challenge, is just becoming comfortable with uncertainty, which is much, much higher prevalent in the microcap space than it is in the large cap space, especially with less coverage, et cetera. And the less experienced people who get spooked, and they sell stuff and the liquidity aspect of it makes things much more volatile, right? But it's also an opportunity from a business perspective. I think it's interesting because I came from a pretty good background. I have a pretty reputable two companies I work for, Darden, and pretty good track record, and focus. There's a lot of people that wanted to give me a lot of money and to shut down Artco and to run a larger cap, oriented thing and become a larger fund. And they didn't want to seed me as Artco when my cap, even back then, was like $50 million. Now it's 35. Mm-hmm. And so the biggest challenge is finding the right investors for your strategy. And that has taken a little bit longer than I had hoped, but I'm actually, it's about $10 million right now, and, started with one $25,000 account. And so we have about 40 some investors. They're all locked in. They're all very well aware of what we're doing. So and I've delivered pretty well by them. You'll see in a few weeks, we're having a really good year. It's up over 50% this year. And, but last year we were down 18, right? And so you just have to be, 2016 we were up like 30. So you just have to make people understand that as much as there is a margin of safety on the permanent capital impairment aspect, the prices of it are volatile, and so that's something that I would say it's a challenge communicating that. And also, there's a lot of institutional investors that are like, yeah, we love you. Call us back when you're $300 million, and we'll give you a ticket. And we'll give you a ticket for $10 million. And I'm like, well, that's but if, our minimum commitment's $5 million, and we don't want to be more than 5% of your portfolio. And we're like, well, that's the opportunity, right? And this is actually a good segue into what we were talking about earlier is why is there this opportunity? And I would say 4.5 years of trying to market myself to various types of investors. It's the career risk aspect of it. The people who write the checks don't want to write checks to companies that are small, and so they can only be the size that I am, and so there's naturally less people doing it. Right, most people get and again, this is all on the margin, right? And I think I mentioned that in my letter. I'm not saying there's not enough smart people in this business. There's just not enough to make the market efficient, and that's kind of both the opportunity and the challenge.
Well, here, let me give everybody some context. So what Peter's speaking to is in his Q3 2019 letter. He asked a question that I've been wondering quite a bit myself, and that when it comes to microcap, small caps, if the returns are so good, why is everyone else not doing this? And he was quoting I'm speaking third person. You were quoting Roger Ibitson's study that showed the lowest size and lowest liquidity stocks produce the highest returns. So you're really speaking to this question about, why is there a dearth of institutional investor presence in the space? And it's really just, again, you kind of just went through it, and I know you're going to expand on it a bit further.
Yeah, I mean, look, the smartest people end up, getting $25 million tickets, seeding tickets. I've certainly had conversation with those who want them to become a $500 million fund or $1 billion fund or, even $300 million fund. And so, look, you can't be a concentrated microcap $300 million fund. You're going to invest 30 million. If you want to be 10% each position, you got to invest 30 million, and you can't, some of our companies are less than 30 million, right? And so
you buy the whole company.
Right. And so certainly, and I think, people sort of misunderstand the costs and expenses of it. They're like, a 35 you'll never scale, but I'm like, I'm one person. And I charge 220, and my expenses are pretty low that most people don't really understand. So in the end, I'll end up building pretty significant wealth for myself via creating value for my investors through the performance fee, not through, a $500 million management, 1% management fee. And I think that makes me sleep better at night, right, knowing that I am not overcharging and I'm not sort of doing something unethical in this particular sense, even though I certainly left a lot of money on the table for myself. What I'm doing now works very well for my personality and for my investors, and should work out really well in the long term. So,
well, it goes back to what you were saying at the very beginning, is that, you talk about for you and your own personal, the way that you view the markets and the way that you want to be an active participant in it. It's not, you're not in it. Yeah, we're all in it to make money, but at the same time, in order to really find these companies where you can generate the highest returns and really get that alpha, it's just the mid-large cap space for you. It's boring, and at that point you're just taking fees.
I said, look, I've been doing this for 4.5 years, right, and I got to send out an email to my clients this week, year-end email, and saying, hey, I made over 50% for you this year. Knock on wood, the year is not over, but we're still December's pretty low key, and it was more of a warning for the tax purposes and some other partnership cleanup stuff that we were talking about. But that certainly felt damn good, right. And I don't know if I could ever send out that kind of email managing mid cap or large cap stuff, right. And so that. Honestly, that made it all worth it. What a high for the week is sending out an email to your people who've taken a chance on you, and you're generating really good returns for them, and everybody's happy, and that's awesome. So
yeah, I'd be pretty stoked to see that.
Yeah, and I'm I'm not old enough to be here with a stoic face and be like, yeah, stuff happens, we're doing well. I'm like, that's fucking awesome. Sorry, I didn't mean to curse, but that's it's building your own business and making money for your investors is a really good feeling, and I'm certainly getting a lot more gratitude out of it than or satisfaction out of being a small guy that's making decent money, than being running a $1 billion shop, having to report to outside investor in terms of running the seeders,
right.
And really not feeling like I'm delivering a whole bunch of value. So that's kind of the. Maybe I don't know if that answers your question, but no, I think there's not enough people. There's not enough people like myself in this. Plenty, and they're part of my network, but just not enough to make a market efficient. So versus a GE or an AIG or something like that, or a Danaher where it has 1,000 investors following them, and I would say the biggest difference is in some ways is just mentally working for mid cap and large cap value fund. I'd go to my boss and be like, hey, I have this 30% undervalued company, and be like, get out of here, that's great, let's focus on this. And now I'm just man, if it doesn't have a 0.00% upside, I'm not interested, right. And that's a very different situational thing. Yeah, that's the fun part. So sure, you have more questions. So let's.
Oh, we could go all day,
Yeah.
but we don't have all day. But I will. We could. This is one of my favorite questions that I love asking all my guests. What would you say is an investing experience that really helped shape your current investing thesis? Most people say it's a loss. Who knows? It could be a gain. It could be a non-investment at all. But what experience would you say that is?
Yeah, I mean, like, look, um, uh, I think certainly, like as I said, losses, like right, having that 2008, having those 2008 losses, like seeing like right front and center Enron. Like I just remember, like this October 2001. It was my senior year, last semester at undergrad, and we went to. BNI Mellon's. I think it wasn't BNI Mellon at the time. Think it was still Mellon's trading floor, and as a class tour, and the guy was like, "Who wants to who wants to guess what Enron bonds are yielding right now?" And I was just like 20%. He's like 120, and I was like. Like right, so no, I don't know. I just specifically remember this, like right, and then like and just reading all those books, like The Smartest Guys in the Room, When Genius Failed, it's like how we're all fallible, understanding that we're fallible, that even the smartest people are fallible. And so instead of people are like, I can't believe you've never heard of this guy. I can't believe you've never read this guy. And I think I think my own experience shaped me. I don't really want other people's experiences to shape me in some ways. But having said that, I think I've had some successful investments in the past, and just recognizing what made them so successful. But I would say it's 80% the losses is becoming loss averse. And so that's one of the main reasons I stay away from leverage. Like, right, I've just seen too many companies get blown up from leverage, and people pitch me the greatest companies in the world, but they'll have 3 turns of debt on their balance sheet. And I'm just like, I don't really want, that's just not a risk I'm comfortable with. And especially microcap managers are not good at managing capital structure. I keep pounding the table on this. If I had to give one advice for younger investors starting out in microcap, don't invest in microcaps with debt, because it's been great in this huge market cycle, but for the most part, none of them have any idea how to manage it. They don't even know what their debt covenants are, and they certainly don't know how to how to deal with a restructuring or something like that. And so it's just a risk, an operational risk that I think is inappropriate for microcaps. And so I would say that, sure, I have 1 or 2 that have one turn of debt, but they have a very good stable cash flow business that can support it, right? And so certain risks I'm more comfortable with. But I think I didn't actually answer your question before. I want to say I have the enhanced value portfolio where I do take risks in some of those companies. They just happen to be 2 to 3% risk, because leverage does create downside, but it also creates significant upside. And so if there is something that I believe has a 10 to 1 risk reward, 50% downside, 500% upside, sure, I'll throw in a few smaller positions in there, and those have worked out pretty well. And that portion of the portfolio has matched the core portion of the portfolio as far as returns, and created some diversification as well. And so, but as far as what has shaped me, I really think it was those losses earlier on in the 99 2000 aspect, and certainly picking some winners, and that my boss at Han Capital has allowed me to put into the portfolio. Like Valiant was one. We've certainly had a few buyouts as well, and so those probably shaped. I think it's experience of making money and losing money that in various different ways.
So what would you say? This is, Guy Ross. I don't know if you listen to How I Built This on that podcast with Guy Ross, but he always asks the question to all the CEOs when it comes to, what percentage would you say your success is due to luck versus, actual skill, and I'm going to ask this question in a different way, because you use a lot of probability in terms when it's not just a black and white decision of when you're assessing a stock. You're saying, okay, 50 to 70% this could work or not work. But at what point after you've done your probability, you've done your algorithm, you're seeing what companies kind of fit that criteria, at what point do you say it's this percentage that all that work led to that company being a success versus just luck?
Yeah, I mean, you can't be successful in this business without luck, and unfortunately, some people have bad luck, and um, yeah, I mean, I would say 50-50. That's probably 50% some lucky things and 50% that I was pretty dead on, and also same thing with losses. Like, right, I was able to use some skill to blow out of certain things that in the end, recognition of past losses has led me to get out of certain things before they led to much more significant losses. And I would say that's certainly lucky that I was able to get out of those with, 10-20% losses versus, 90% losses that came later. And so, yeah, I'm certainly not going to tell you that I'm the greatest investor in the world, and please, I don't listen to anybody who will ever say that, because a significant portion of it has been luck, like, and I will sit here with a straight face and tell you that. So.
Well, part of the reason I even asked too is, in our discussion about management, these are human-run businesses. It's not robots. I mean, all humans are fallible. There has to be luck involved when it comes to being successful or a failure.
Here's a good one: like joint chiropractic, like, right, the one that we've mentioned, like, right. So I usually like to have management to be invested in the company have a significant stake. We all do, like, right. But I think we're all used to that sort of large cap, mid cap guys that went to top business schools, probably own like $3 or $4 million to $20 million worth of stock. And then you get down to the micro caps, and these guys are making a couple of $100,000 a year, and they never went to top business schools. They're probably local Wichita State. There's anything wrong with Wichita State.
Nothing wrong with Wichita State.
Yeah. Basketball team. It's more of like, they're just not going to have the money. So with joint chiropractic, look, I straight up, like, I was like, hey man, how come you don't own more of the stock? And he's like, I got kids in college. I gotta, I'm sorry, I gotta pay tuition and stuff like that. And I mean, that's a human fallible answer, like, right? Some people, and maybe that's the experience of reading management, body language, etc. But that was a guy that was straight up honest to me. And I was like, I wish I could own more, but I got to pay for my kids' college, like, right? And that's as good of an honest answer as I could have hoped for, and have an honest response, and that honesty meant more to me than him not being invested in the company. And so I think that's probably the most important thing to recognize in this business, is that we are all human beings. Like, whatever mistakes you made, this guy that you're idolizing, that's a CEO, that he's probably made the same mistakes. Like, he probably got drunk one night a little too hard and said some inappropriate things, and woke up the next day, recognized it's a mistake, and went on. Like, right. And so that happens. And I think lowering your expectations and being more understanding that they're more human is different. But I think at the same time, those guys are much hungrier to create wealth and take risks that create wealth that the large cap guys don't. And I think that's the art here, is figuring out, are these guys hungry enough to make money? And sometimes you just got to ask them that straight up. And so to your questions to management, that's probably the question I ask. My one question to CEOs are like, why are you doing this? Like, right, I want to hear them. It's like, I want to get stinking rich. And I'd rather hear that than have some sort of like nebulous, like, I want to make the world a better place. I'm like, I want to get stinking rich with you, so I'm glad you're doing this. Like, right. And so that's probably the answer here. So
I like it would be funny to hear that, like, just be a fly on the wall if you got that answer. Be like, oh, make the world a better place. Okay. Gotcha. But
yeah, no, I mean, I'll just go with like, okay, bye. So you're talking to the wrong person here.
So we're rounding the bend here, and my last question, you actually already gave one bit of advice already for new microcap investors, and for you, talking about just try and stay away from companies that have little to no debt. What other advice would you say for new microcap investors wanting to look at this space?
Yeah, I mean, like I said, I know it sounds so silly, just like start playing poker, online poker, like, you know what I mean, for free, like, practicing, and just because I think what poker did is created comfort with volatility and comfort with losses and coming back from those losses and being comfortable with the risks, like, for for some people, betting 5% of the hand is a whole lot. For other people, is betting 20% of the hand is just right. Like, or of your stack. And so what that did for me is I think it's made me much more my gut much more comfortable with the risks I take. So I would say that's one silly bit of advice that's probably not like is not one that you probably hear from people, but surprise, surprise, a hedge fund manager or investment manager that likes to play poker. Einhorn likes to play poker, and so and he's spoken about it. That's made him a better investor too. As far as like experience goes, I mean, I think just try to follow as many companies as you can and, invest $10 in it. I don't care. Like, right. But once you, sometimes there's companies that I don't want to make a full position, but I will buy 100 shares for a portfolio that's, 1 basis point, just so I'm start monitoring them and maybe I'll add to them. So maybe there's like 20 basis points of our portfolio and like, 15 stocks that I'd never count as anything else, but they're, but they get me invested enough to keep an eye on them. And so once you have some dollars invested, I think you become much more focused. And so rather than let me check back in 3 weeks to see what they reported and things like that. And so I think that's probably a bit of advice. I think it's just experience and losing money in the most creative way possible is your best bet. Like, right. So that's my, I guess, advice.
Just lose really creatively. Like there's a South Park episode where they're trying to lose in the little league.
And it's gone.
Yeah,
like, right?
So,
you know what? Another one that I would say that's a little bit off the beaten path is like Twitter has been this just fantastic source for me, my career, my personality, etc. There are a lot of very, very smart people on Twitter that sometimes they're anonymous, like, right? And they don't, because for compliance reasons, that they're pretty shy about posting and stuff like this and everything like that, but they'll end up having conversations with you in the DMs, I guess, and direct messages. And so I think that's a resource that's highly underutilized by our industry currently, and I would say that's almost a competitive advantage. So I would say go to Twitter, post your thoughts, talk with people, but just be mindful that not everybody's going to respond to you and that don't take that personally. Sometimes you might be 100% wrong, and Twitter will prove that to you in not very nice ways. You gotta take the good with the bad. But I would say, what an amazing resource that a lot of people in my industry don't utilize, and it's kind of crazy. So
it's the best. I love it.
There's just me. Like, this website is free. Like, you get like the best information. That's great. So anyway,
so Peter. So we're
half of this. That's not even that doesn't even count.
I guess you must have had a good time. I'm just saying. Yeah. But so Peter, we're there, and where can my audience go and find more information about you and Arco Capital?
I mean, I think my Twitter account, Artko Capital, is where you can communicate with me the best. I'm weary of a little bit of marketing because I can't. You can email me, peter@artcocapital.com. If you have questions, I will try to answer. I get a lot of emails that I'm sorry, I just don't have time to. Prospective investors have to be qualified. And so if that's what you're looking for, I'm just letting you know that we can only take qualified investors, and same email address you can reach out to. And so I'm trying to be very wary of not marketing myself and not breaching any securities laws here. But like I said, that's probably the best way to get to know me. So
cool. Well, Peter, thank you again for joining me on the Planet MicroCap podcast. It was so much fun, and go finish your drink, man. Have a good time.
Thanks, man. I appreciate it.
All right. Thank you.